Trent Ltd delivered an impressive performance in Q2 FY25, with revenue jumping 39% to 4,157 crore rupees, though this fell short of Bloomberg's estimate of 4,388 crore rupees. EBITDA surged 41% to 643 crore rupees, underperforming slightly compared to expectations of 670 crore rupees. However, margins were solid at 15.5%, in line with estimates. Net profit rose sharply by 47% to 335 crore rupees, but still came below the forecasted 431 crore rupees. The results highlight robust growth, but with some areas that missed market projections. Trent Ltd, a retail arm of the Tata Group, commands a market capitalization of over 2.3 lakh rupees crore. The company operates across retail segments like fashion and grocery through formats like Westside and Judio. At its current price of 6,521 rupees, the stock has a high PE ratio of 185, reflecting significant investor expectations. Return on equity, ROE, stands at an attractive 27.2%, and return on capital employed, ROCE, is 23.8%. These figures indicate Trent's strong profitability in a highly competitive retail sector. Analyzing Trent's valuation, the PE ratio of 185 is significantly above its historical median of 184.5. The question is whether Trent can sustain high growth rates to justify this premium. For comparison, DMart saw a sharp correction when its growth story slowed. Trent faces similar risks if it doesn't maintain its performance. Despite robust growth, the valuation appears demanding, and any slowdown in sales or margins could lead to a substantial derating of the stock. Over the past 5 years, Trent has achieved remarkable compounded profit growth of 57% and sales growth of 36%. More recently, profit growth has accelerated, with TTM figures reflecting a 180% jump. Sales have also grown consistently at a TTM rate of 53%. This consistent upward trend in financial metrics is a key factor driving the company's premium valuation. However, sustaining such high growth rates will be crucial to maintaining investor confidence. On the technical front, Trent is currently trading at a significant discount of around 22% from its 52-week high of 8,346 rupees. The stock is, however, showing signs of support at a crucial trendline, which has historically acted as a strong floor. Investors will be closely watching if this level holds, as a break below could signal further downside. The long-term uptrend remains intact, but the stock needs to stabilize to prevent further bearish pressure. Clean Science and Technology posted its Q2 results with revenue up 31.5% year-over-year to 238 crore rupees, close to the expected 239 crore rupees. EBITDA grew 20.5% to 90 crore rupees, slightly below the expectation of 102 crore rupees. Margins came in at 38%, falling short of the anticipated 53%, indicating rising costs or pricing pressures. Net profit rose 13.5% to 59 crore rupees, missing the forecast of 73 crore rupees. These mixed results reflect strong top-line growth but challenges in maintaining margins, which impacted the bottom line. Clean Science and Technology, a small-cap company with a market capitalization of around 15,700 crore rupees, operates in the specialty chemicals segment. It specializes in manufacturing critical chemicals used across industries, including pharmaceuticals and performance chemicals. Established in 2003, Clean Science has built a reputation for innovation and sustainability in chemical manufacturing. Despite its smaller size, the company holds a significant position in the global specialty chemicals space, competing with larger players by focusing on high-quality and differentiated products. Currently, Clean Science's stock is trading at a PE of 62.5, close to its historical average of around 64.1. This suggests the market is valuing the stock based on its historical growth trajectory. However, with recent pressure on margins and profitability, the question arises whether this valuation is sustainable. If the company's growth continues to slow, a derating could occur. The current valuation is demanding, leaving limited room for error, and investors may need to reassess if growth doesn't pick up in the coming quarters. Over the last 5 years, Clean Science has reported steady growth, with a compounded annual growth rate, CAGR, of 15% in sales and 20% in profits. However, recent quarters have shown signs of a slowdown, primarily due to margin compression and competitive pressures. The recent drop in profitability has raised concerns among investors about whether the company can sustain its historical growth rates. This inconsistency has impacted investor confidence and could be a factor in its underwhelming stock performance of late. On the technical front, Clean Science's stock is trading at a 13% discount from its 52-week high of 1,690 rupees, currently hovering around 1,477 rupees. The stock has struggled to find momentum due to recent performance concerns, with lower highs indicating weak sentiment. Key support levels around 1,262 rupee have held up so far, but a failure to break resistance at 1,615 rupees could lead to more consolidation or downward movement. Until fundamental performance improves, the stock may continue to face pressure. Indigo Paints reported a mixed set of Q2 results. Revenue increased by 7.4% year-over-year to 300 crore rupees, slightly below the expected 304 crore rupees. EBITDA came in at 41.5 crore rupees, missing expectations of 46 crore rupees, with margins shrinking to 13.9% from the anticipated 15%. Net profit declined 12.1% to 22.3 crore rupees, underperforming the forecasted 25 crore rupees. The subdued performance, especially on the profit and margin front, highlights rising cost pressures and challenges in maintaining profitability amidst tough competition in the paints sector. Indigo Paints is a small-cap player in the Indian decorative paint industry, with a market capitalization of 7,762 crore rupees. Founded in 2000, the company is known for introducing innovative paint products like metallic emulsions and tile coat emulsions. While Indigo Paints has managed to establish itself in a highly competitive market dominated by larger players like Asian Paints and Berger, its smaller scale leaves it more susceptible to market dynamics and aggressive competition from newer entrants, such as Birla Opus. At a current PE ratio of 54.7, Indigo Paints is trading near its historical median of 55. This indicates that investors are valuing the company similarly to how they have in the past, despite its recent financial challenges. The valuation appears demanding, especially given the margin contraction and intensified competition. For a company to sustain such a high PE, consistent growth and operational efficiency are crucial. If Indigo Paints fails to improve margins or growth metrics, it may face a downward re-rating in the stock price. Over the past 5 years, Indigo Paints has delivered a compounded annual sales growth of 19% and profit growth of 40%. However, the pace of growth has slowed recently, partially due to increased competition from Birla Opus, which is shaking up the sector. Even larger players like Asian Paints and Berger are feeling the pressure, impacting their stock performance. Indigo Paints stock has been testing resistance levels, and the uncertainty surrounding future growth remains a concern for investors. Technically, Indigo Paints is trading around 1,620 rupees, a 6% discount from its 52-week high of 1,720 rupees. The stock has struggled to break above this resistance zone, reflecting investor caution. Despite recent attempts to recover, the stock remains under pressure due to the company's operational challenges. Support is seen around 1,250 rupees, and a failure to hold key levels could lead to further downside. Until fundamentals improve, the stock may continue to face selling pressure near resistance zones. This analysis is purely for educational purposes and does not serve as a buy or sell recommendation. Always perform your own research or consult a financial advisor before making any investment decisions.